Hey everyone, it's Mark from Copper Canyon Tax and Accounting Services, and welcome to this summer series video. Today I want to tackle some financial topics, including everyone's favorite topic, budgets. Why do we need a budget? A budget is simply a spending plan that accounts for your income and expenses and helps you to keep track of your money. Almost every time I've worked with someone on a budget, they are shocked by at least one category. Usually it's meals and eating out. It can quickly add up to $1,000 a month. Why is a budget important? A budget is the starting point for building an emergency fund, your savings, your life insurance, and your retirement. What does a budget look like? If you've run a business or have ever seen financial statements, there are typically two go-to forms: a balance sheet and a profit and loss. There is a third report that many small businesses don't use, and that is called a cash flow report. Your budget will look like a cash flow report. All the money coming in minus all the money going out. To make it fancy and more functional for you, it should list income and expenses by category: wages, interest, dividend, rental income, whatever you have. Expenses would be housing, utilities, groceries, insurance, eating out, entertainment. Now that you have that all worked out, does your expense list include PYF? What's PYF, you ask? Pay yourself first. Your budget needs to include savings for emergencies and retirement. Don't save what's left. Spend what's left after you've saved first. Now that you know what your actual monthly expenses look like, you can work on your emergency fund. Now, emergency funds are a funny thing. If you ask 10 people, you'll get 10 different answers. So, here's answer number 11. Step 1 is to consider your potential for becoming unemployed. Is your job secure? Do you have a lush government job with great benefits? Or are you working in an industry that is dying? Will you have trouble finding a job if you get laid off or fired? Factor that in. If your job is secure, you should keep enough cash on hand to cover basic emergencies like the air conditioner breaking down when it's 110 degrees outside, or to cover your tax liability in April. If you have a chance of being out of work, you should determine how long it may take to find suitable work and plan for a worst-case scenario. Take your expenses and multiply that by 4 to 6 months, and that would be a good starting point. Remember that during times of unemployment, you won't be paying into Social Security or Medicare, and you won't be funding your 401k at work. So the difference between your income and your take-home pay could be a large number. This is why we want to use your expenses and not your income for determining the amount in your emergency fund. I want you to think of your life as a business and think of every dollar as an employee. Good little employees that are working 24 hours a day to make your life better. Or are your employees sitting in the break room wasting time? Each dollar you have has a special purpose and a special job. Your emergency fund needs to be cash or cash equivalents. We are now a full generation into low interest rates, and some of you don't know what you're missing. In 1999, my money market account was paying 6.5% interest. That party ended in 2000 and has never come back, and I really don't expect to see those kind of rates again. This leads us to a problem. Well, multiple problems. Cash sitting on the sideline isn't doing anything, including keeping up with inflation. People are trying to sell you guaranteed products that are locking you in at rates that are terribly low by historical standards. And people start seeking unicorns rather than following sound financial advice. Now back to those dollars. Your emergency fund doesn't have a lot of options. Rates are low, but this needs to be in cash. One option that I recently discussed with a client was CD laddering. A CD ladder is a structure where you take your emergency fund and divide that into a monthly budget amount. Then you purchase a limited term CD every month. Let's say your monthly expenses are $4,000 and you've saved up $24,000 in your emergency fund. On August 1st, you would put $4,000 into a 6-month CD. On September 1st, you would put another $4,000 into a different 6-month CD, and so on. January 1st, you would invest your last $4,000 in a 6-month CD. February 1st, your first CD expires. If you're employed, you let it roll into a new 6-month CD. On March 1st, your second CD expires, and you either have access to the money or you let it roll into a new CD. Each month going forward, you have access to money, or you can let it roll. 6-month CDs are currently paying 0.5% to 0.65%, and if interest rates rise, your return on investment rises with each renewal. This strategy also forces you to live within a budgeted amount if you find yourself out of work. Now that we have your emergency fund taken care of, let's talk about the rest of those dollars. There are a lot of terms for investments, and I think that this scares some people. For those of you that don't know, I've been an investor for about 30 years, and I studied the Certified Financial Planner program. At one point, I decided I'd rather work with people in an independent aspect rather than as someone selling them a financial product. So here we are. We've mentioned cash and cash equivalents. This is money that is available now and doesn't change in value based on the daily ups and downs of the stock market. In exchange, you're paid interest. There are fixed income products. These are investments that produce a steady stream of cash, usually at a guaranteed rate. Bonds fall into this category. Bonds can be issued by corporations, the United States government, states, or cities. The taxes you pay depends on who issued the bond. Equities is the term used to describe shares of stock in a company. Stocks fall into several categories and are described as growth, income, value, small cap, large cap, or international. An equity investment is money that is invested in a company by purchasing shares of stock in the stock market. Now, these terms all work together in portfolio design or asset allocation. Should you have a growth portfolio, a balanced portfolio, or an income-producing portfolio? Two major factors come into play, and working with a professional is really in the best interest for most people. So what is your time frame? Time frame plays a huge role in how your money is invested. And what is your risk tolerance? Earlier this year, my phone rang dozens of times when Bitcoin went from $20,000 to $50,000. Everyone loves risk on the way up. Mark, how can I set up a self-directed IRA? How do I invest in crypto? I didn't receive a single phone call when Bitcoin dropped from $55,000 to $35,000. In order to understand your risk tolerance, you have to recognize how much downside you're willing to take. Let's say the stock market just dropped 10%. Are you okay if your portfolio dropped 10%? Or would you be more comfortable if your portfolio only dropped 5 or 6%? Or are your nerves made of steel and you'd be okay if your portfolio dropped 15 or 18%? Some of my best holdings are stocks that dropped drastically after I bought them. A few years ago, I purchased Zendesk, great company, and a growth stock I wanted to own. I bought it at $30 a share, and almost immediately it dropped to $20 a share. But I got nerves of steel, and I bought the stock for a reason. 5 years later, it's trading at $145 a share. So, when you're thinking about portfolio design and how you're invested, risk equals reward, and the less downside risk that you're willing to take, the less potential upside that you will see. But this isn't a bad thing. What's important is time, planning ahead, having an emergency fund so you don't have to touch your long-term savings, and sticking to a sound financial plan. I want to talk about the Rule of 72 before we jump into a boring portfolio that I designed with the help of my financial advisor pal, Wyatt McCrae. The Rule of 72 is a quick formula you can use to determine the length of time it will take for your money to double. Imagine being 21 again and receiving a $10,000 gift. And you have three options. You can invest it at 3%, 6%, or 9%. To apply the Rule of 72, you take 72 and divide it by 3. That equals 24 years. You take 72 and divide it by 6, and that equals 12 years. And finally, 72 divided by 9, and that equals 8 years. You can see on this chart that the 3% money will double to $20,000 at age 45 and double again to $40,000 at age 69. And here you can see that the 6% will double at age 33, 45, 57, and 69, giving us a total of $160,000. And finally, you can see the 9% double at age 29, 37, 45, 53, 61, and 69, giving us a total of $640,000. Now, the stock market doesn't go up in a straight line, and at age 69, you need to be invested differently than you were at age 21. But this should tell you that the rate of return and the time invested are both important. All right, last month, me and Wyatt sat down and picked a handful of stocks and a few mutual funds. Boring stuff, mostly household names with a focus on dividends and making sure that we covered several different industries to diversify our portfolio. The names we came up with are Chevron, Duke Energy, Honeywell International, JP Morgan Chase, Microsoft, Procter & Gamble, the Walt Disney Company, and the Home Depot. We grabbed 4 mutual funds to make sure it was a financially sound, well-balanced portfolio. The objective was to see how well boring can do over time. We took $20,000 and invested it on January 1st, 2020. Each month, we invested $500 and split that equally between all the investments. All dividends and distributions were reinvested. The chart runs from January 1st, 2020 through April 30th, 2021. During this time, we've lived through Y2K, the tech bust, 9/11, the housing market collapse, low interest rates, the lost decade, Greece almost defaulting on their debt, Brexit, trade wars and tariffs, and COVID-19. During that time, these boring stocks delivered a total return of 876% with an average annual return of 11.27%. During those 21 years, we invested $148,000 and we have an account value of $685,562. No Apple, no Netflix, no Amazon, no Bitcoin, and no meme stocks. Just a solid long-term plan. This brings us back to that budget. There's always room in your budget, but you have to face it, and I'm here to help you. One of the most important things you can do is to focus on tax-efficient investing strategies. This is different for everyone, and that's part of what we do. If we're talking and you hear me say, if it was me, I'd do this. That's your cue. The tax guy, the guy that doesn't pay a lot of tax, would set it up a specific way to make it tax efficient. Retirement is a long process, both on the saving side and the spend down side. You don't turn 67 and retirement is over. you need to plan on a retirement that could last 20 or 30 years. Let's take a quick look at the math. Step 1 is to look over your budget and figure out which expenses will still exist and which will be gone. Having your mortgage paid off is really helpful. Now that we have a number, we need to adjust it for inflation. Are you 5 years away from retirement, or are you 20 years away? Things will cost more in 20 years. I guarantee it. So let's assume that you want to have $70,000 a year in income at retirement. Now we need to look at your Social Security benefits. Let's assume that you're married and one spouse will receive $2,000 a month and the other will receive $1,600 a month. Social Security claiming strategies become really important here. You're locking in a guaranteed stream of income. All right, $2,000 a month times 12 is $24,000 in benefits, and $16,000 times 12 is $19,200 in benefits. $70,000 income that we want minus $24,000 minus $19,200. That gives us a shortfall of $26,800 a year. That's the amount we need to replace. Now comes the scary part. Take $26,800 and divide that by 4%. That equals $670,000 in assets that you will need to have invested at retirement. Now consider the amount that you would need if you want to have $100,000 or $125,000 of income each year. What about life insurance? I think my blood pressure just went up. I hope to settle this debate once and for all. Would you rather have $1 million in tax-free life insurance, or would you rather have $5 million in taxable investment income that you would have to pay 20% tax on? I'll give you a minute to think about it. The worst case scenario is you're going to pay about $1 million in tax and have $4 million left. In the best case scenario, you stretch out those investments over your life, your spouse's life, your kid's life, your grandkids' life, and you're going to pay a fraction of the tax on that investment income. Life insurance is important, but life insurance is not an investment. It can be an investment, but that really only applies to about 1% of the population. Call me. I can help you assess your needs and discuss the right type of insurance for you and your family so that you won't be sold something that you don't need and shouldn't be paying for. Enough about that topic. Another term that comes up a lot is opportunity cost. Opportunity cost is the price you pay for doing one thing versus another. 2020 was a great example. Congress gave people the ability to withdraw money from their retirement accounts without paying a 10% early withdrawal penalty. Many people chose to dig in and take huge distributions. Some tossed that money into a savings account earning less than 0.5% interest, and then the stock market rallied 30% by year end. The opportunity cost of having cash on hand was losing out to inflation and underperforming the stock market. This applies to all aspects of your financial life. Should you pay cash for a house or car? It depends on what the money is doing and how much it costs to access it. If you have $20,000 sitting in a bank earning no interest and it's not your emergency fund, you probably shouldn't have a car payment. But if you have to take an early distribution from a retirement account to pay cash for a car, maybe a car payment isn't so bad. You are jeopardizing your retirement and you're creating tax out of thin air. Lastly, home refinancing. Please stop refinancing your house. In the economic world, we have a term, zero-sum game. The answer is always zero. There's one winner and one loser. Think of the Super Bowl. One team wins and one team loses. In the case of a refinance, the bank wins and you lose. Yes, there are a few exceptions, but I have math and spreadsheets on my side and can show you how you're going to lose the majority of the time. Let me ask you a question. If you looked at a $250,000 house and then looked at a $175,000 house, would you expect to make a lower monthly payment for the $175,000 house? I hope you said yes. Refinancing works the same way. You borrow $250,000 and pay one mortgage. Then, after years of payments, you are enticed by the offer of a lower interest rate and a lower payment. You go to the bank and you refinance your loan at $175,000, and magically you have a lower mortgage payment. Well, no kidding. You borrowed $75,000 less the second time. Now you reset your amortization schedule. You pay on your mortgage for 40 or 45 or 50 years. Your house is potentially never paid off. And then you have to come talk to me about a reverse mortgage. I'll save that topic for another day. So, I want you to set a goal, and I want you to work towards saving 10% of your income. Be on the lookout for more Summer Series videos where I'll talk about real estate investing, Social Security, reverse mortgages, taxes, retirement accounts, and Arizona tax credits. Visit CopperCanyonTax.com to upload important documents through our secure portal, to schedule appointments, and to read the latest tax newsletter. I'm here to assist you with tax planning, retirement planning, when to take Social Security, and to help you with your budget and accountability.